Hello, my friends. Brett Pattison here, coming at you from the financial capital of the West. That is Salt Lake City, Utah. Thank you for taking time out of your busy day to listen to the first of three webcasts that will be about options. We call this Know Your Options, How Options Can Help a Portfolio. And I'll say this right out of the gate. There are a lot of misconceptions about options. Two in particular that I hear all the time. Number one, and they're completely opposite of each other, by the way. But the first one is that options are too risky, that you'll lose all your money by trading options. And I would say that's true for people that don't know what they're doing and that utilize the wrong strategies at the wrong time. Options can actually carry a lot less risk than owning stocks, for example, in certain situations. And so you always need to understand the risk, but they aren't too risky if you know what you're doing. The second thing is completely opposite of that, and that is that you can get rich overnight, that you can have 100, 200, 300% returns by trading options. And I don't think that's true either, because that would then mean you're taking way too much risk. And both, to me, are misconceptions and are ridiculous if you know what you're doing with options. And so that's the goal of the webcast, is to teach you a little bit about options and how we utilize options as a firm. In fact, today what we will discuss is the role of options in a portfolio. We'll discuss three. We'll talk about the impact that options can have on a portfolio, which might surprise you, of the impact with very little capital that it can have on a portfolio. And the third thing, we'll talk about when to trade them and when not to trade them. There's a time and a place, and this is very, very important. In all my years, my 15 plus years of trading options, there's a belief that you can do the same strategy month in, month out, year in, year out, and be successful. And that's not true. The market changes, and the market's going to give you opportunities to trade certain things at certain times. And so that's important, and one that we'll look at specific today. And then surrounding a strategy, we'll address one strategy for consideration that has probably been our most popular strategy over the last couple of years, and I'll explain to you why. First off, let's hit some disclosures. Options may not be suitable investments for everybody if done incorrectly. Or if you just lose on a trade, they could result in a loss that could be more than the initial investment. Examples in this presentation are just that, examples. Past performance doesn't indicate future potential returns or losses, and the webcast is for educational purposes only, just to make you a smarter investor. So real quick, just so that everybody's clear, Iron Gate Global Advisors is a firm where we manage all the money in-house. We do not farm out to anybody our portfolio management. And Brian Hunsaker is a portfolio manager, actually started the firm back in 1999, and he specifically deals with value investing. He is one of the great stock pickers that I have seen in my career, which is in large part why I partnered with him. He's a great man, a very honest man, and a great stock picker based on value investing. So I partnered with Brian 3 years ago this month, actually, and my specialty is options. And so later in the year, you'll have an opportunity to attend a webcast from Brian about value investing. But I just wanted to give you an idea as to how we work as a firm, and specifically our process, which I get asked this question a lot. Like, what kind of returns are you focused on getting for clients? And people are surprised at my answer. And that is, we don't focus on returns. We focus on our investing process, which is largely probability driven. So when we analyze a stock, when we look at an option, it is, okay, we want to understand that investment as much as possible, or that trade as much as possible, and we want a higher probability of being successful than not. And that's not a guarantee that we're going to win on every trade or every investment, but anytime we're trading stocks or options or even looking at private investments for people, it's all probability driven, and we know if we do that and focus on our process, that the returns will come, and they have come over time, and I'll address that a little bit more. The role of options in a portfolio, let's discuss that. This is a basic portfolio allocation. It's actually one of our higher risk, almost all equities, as you will see. We have 60% in individual stocks, our value investments. We have 30% in ETFs, equity-related ETFs. And then we have 10% in options. And so you can see that options are a supplement to a portfolio. We'll put, depending upon the risk that the client is comfortable with, we'll put 5, maybe 3%, 5%, up to 10% of that portfolio in options. That's how we build portfolios. It's not 30% in options. It's not 60. It's roughly 10. And you'll see how powerful that 10% or 5% can be here in just a moment. So as we do that, options can be used for 3 things. Income, number 1. Number 2, protection and hedging. And income, that's what we'll address today, so I'm not going to get too far into the details now, but protection and hedging, and again, we're going to have webcasts on all 3 of these that we'll bring up. Protection and hedging is a way for people, it's a way for us to reduce risk in a portfolio with options. It's a way for us to, if somebody has worked their whole life at a company that just goes public and they have a lot of stock in that particular, or a lot of money in that particular stock that just went public, it's a way for us to reduce risk and protect their wealth. There's a lot of things that you can do with options as far as protection and hedging and income. The third thing, speculation, which is directional bets, which we don't do a ton of. I think we'll do a lot more of that in a bearish market than we do in a bullish market. But that's where you think a stock's going to go higher or lower, and so you buy a call or put to take advantage of that directional speculation. And again, we don't do a whole lot of that, and we'll address that more in the webcast that we do on speculation. But as far as income goes, that's the goal for today, is that you understand a basic income strategy and how we apply it to portfolios. So let's discuss, before we dive into the details on a particular option strategy, let me just discuss the impact that it can have on a portfolio. And this is a 2016 income example that has occurred in portfolios. And I would say this, before I bring up any of the account information, which I have adjusted slightly, and I'll address that. But I would just say this, the type of account matters when it comes to options. We can do a whole lot more in a cash account, a trust account, an individual account, than we can in a qualified account, a retirement account. We still do these types of strategies in retirement accounts, but we can be a little bit more fancier just because of the type of the account, if it's individual or cash. That said, certainly we can do any of this in retirement accounts as well, but the type of account does matter, and I just want to make that clear. So this example is an account size of $500,000, and over the course of a year, we created right around $20,000 of income for this particular account, and the portfolio return just on options was 4%. 20,000 to 500,000 is 4%. Now, if you think about that, you have 10% of your portfolio, and that 10% of your portfolio in options helps create 4% of your total return, total portfolio return. That's a significant impact on your portfolio. And I'll share with you what kind of effect that has over time for those of you that look at 4% and are saying, hey, big deal. It is a big deal. So here's an example of the impact that it can have on a portfolio to give you an idea of that 4% and what it means longer term. This is just a basic compound calculator, and I inputted the current principal at $500,000, again a $500,000 account. The years to grow, I put at 20. Most clients we have a lifespan of 20 plus years, although some are a little bit shorter than that. Most are 20, 30, 40, 50 years. The interest rate I put in at 9%. And I'll show you why I put in that 9%. And that is because in our all-cap value portfolio, which I'm going to bring over onto the screen, our all-cap value portfolio, which is our value investing, which Brian has started really since 1999, as you can see all these numbers here. The annualized return over time is 9.04%. I rounded down to 9%. So that's why I put 9%. Compared to the overall market, by the way, the S&P 500 annual returns are 4.5%. So we're really proud of that historical track record. As you can see, we've been able and been blessed to outperform the market over time on an annualized basis, almost double or double the market. Knock on wood, that continues. No, right? No. Past performance is not indicative of future returns, but we are proud of that, and that is why I put in the 9%. So compounded 9% annually over 20 years, your $500,000 turns into $2.8 million. Okay, your $500,000 turns into $2.8 million. Now, here's where options come in. Because let's say we can take that 9% and we can add 2% to it, and we can raise that up conservatively compared to the 2016 example, which was 4%. I'm just saying 2%. So we take that 11 or 9%, we add 2% to it, we're at 11%. The difference is now you've got future value of $4 million. $4 million, I'm going to flip back here, $4 million compared to 2.8. So $1.2 million more just by doing a little bit of options and getting a little bit better return. And that's not a guaranteed 2% return every year or a 4% return. You're going to have your winning years, you're going to have your losing years. But over time, if you're able to do that and add 2%, that can dramatically impact the future value of the portfolio. The key that it takes is patience. And I'll tell you why I say that. Because there's a lot of clients or prospects that I talk to that want more options, and they want more than 4% returns on that option allocation. And my response to them is just be patient. I'm not going to we're going to handle risk. Risk is the most important thing, and we'll be patient and we'll trade accordingly. And trust me, over time you'll see it. You'll see it. We're not trying to get rich overnight. That's not the goal of why we do options. It's to create a little bit of alpha, so to speak, industry term, right? Additional return that the rest of your portfolio isn't generating. So patience is the key. So the last 2 years, as far as strategies that we've done with options, are mainly selling puts, which is a bullish strategy, or what's known as a bull put spread, also known as short put spread. I'm not going to get too far into the weeds on the spread, because I know many of you are novice option traders, or your understanding of options is very limited. So I'm going to focus on selling puts, but there's also other strategies that we will use. Some covered calls when it's appropriate, some bear call spreads, also known as short call spreads. We'll do iron condors, we'll do double diagonals, we'll skew our condors to be bullish or bearish, and we'll do some other fancy things when it's appropriate. But really, the last 2 years we've been mainly doing, because we're bullish in this market, selling puts and bull put spreads. In fact, as of last week, we had done right around 34, it's either 34 or 35 option trades this year, and we haven't lost yet. Knock on wood, that continues, but it's because we've been mainly bullish, because the market's bullish, and that makes sense. So let's take the selling put strategy, and let me just dissect a few rules to give you an idea as to how and why we sell puts. So the first rule on selling a put is that you have to do it on stocks that you want to own. And I'll address a little bit more why in a second, but you always have to have it on a stock that you want to own. And so this is where Brian my partner and I really work together hand in hand, and that is if there's a stock that is trading at a good value and we're comfortable owning it, then that's a stock that becomes a candidate for selling puts. So you have to do it on stock that we own. This is a chart of a stock that we own. I haven't put the ticker symbol there so that, for compliance reasons, but that is an example of a stock that we really love that's in some of our client portfolios, and so that's what we'll use as our example. So that's the first rule: select the stock that you want to own. Second rule is you've got to select an expiration. Every option has an expiration date, meaning the last date that option contract will be in existence. And it's always the third Friday of the month that option expires, and so I'm looking out 58 days in this example, anywhere from 20 to 60 days on average. It's not always perfect, but 20 to 60 days. I'm looking at an expiration cycle in November of 58 days, as you can see circled there. So select the correct expiration, and that leads you to the third step, which is one of the most important, and that is you've got to select the option you want to sell. And you do that by asking yourself the question, what price do I want to own this stock? If this stock comes down in value, what price am I comfortable buying it at? So I have the 85 or 80 circled here, and those are two prices that we would buy this stock at if it does fall. I buy it at 85, I buy it at 80. Yes, I'm comfortable owning it. And so those are a couple questions that you have to ask. For the purposes of this example, we'll utilize the 85 put. As you can see there's a couple columns. On the left it says bid, on the right it says ask. 135 by 190. The bid price is what we sell it at, and somewhere in between is where you're going to get filled. I have here that we get filled selling that 85 put at $1.60. Okay, so if we sell that 85 put at $1.60, what does that mean? Well, here's what it means. First off, and this is where the income comes in. First off, you receive $160 per contract that you sell. So if you sell one contract, you're making $160. If you sell two, double that. Three, triple that, right? So you take $1.60, you times it by 100. That's the money that you receive for entering into the contract. I sell the put, I receive that money, regardless of where the stock goes. Okay, so again, let's elaborate a little bit more. What does that mean? Well, and how do I really make money? And where's the risk? So here's the thing. If the stock falls to 85 at expiration, and here's the risk part, and what entering the contract, like why are you receiving $160 per contract? Well, this is why. If the stock falls to 85 at expiration, you're obligated. You don't have the right, but you're obligated to buy the stock at 85. And if you do one contract, you're obligated to buy 100 shares. Well, that's why I asked the question, what price are you comfortable owning stock? Well, if I'm comfortable owning the stock at 85, I'm okay with this. I'm okay with that obligation. If you're not, then you're in trouble, and you shouldn't have entered the contract in the first place. But by selling that put, I take an obligation upon myself to buy that stock at $85, and by doing that, I'm paid $160. So I get $160. If the stock falls to 85, I'm obligated to buy the shares. So my risk is this: if the stock falls below 85, that's my risk. So for example, if the stock falls to 75, then I lose $10, right? I have to buy it at 85. It's selling at the market for 75, so I'm already down $10. That's the risk. And in that scenario, I still receive my $1.60, so I'm really only down $8.40. That's the risk. If the stock falls to $65, well, I'm down $20. That's the risk in this type of trade, and that's why understanding the stock, its fundamentals, its value is so important. That's where Brian and I and our strategies merge together so well. Not that it works every time, but understanding the stock is very important, as you can see. So that's the risk. So what do I need the stock to do to make money? I need it to stay above $85. Here you can see where the stock's trading. At the time I captured the option chain and the other images, and it's about 97.50. I'm selling the 85 put, so the stock would have to come down in value quite a bit. It's done that before, but it'd have to come down quite a bit in value. And as far as the option goes, there's an 83% probability that I receive my $1.60, which means that there's a 17% probability as far as the options are priced that I lose. So not a guarantee. There's no guarantees in the world of investing, but there is a higher probability of winning than losing, and this is one of those examples. So that's the basic idea of the strategy, is sell puts underneath the stock price at a price you're comfortable owning it and receive income to do it. You can see just by looking at this specific example why we've had such a great record this year in our option trades. High probability on stocks we own that we know, and you create income. It's a pretty cool strategy, pretty basic, but can have a pretty large impact over time. So that's the trade. And if you have any questions, you can email me at brett@igga.com. More than happy to talk about it with you. So that's not it, though. There's a certain time or best time to trade this specific strategy. It's not just any time you wake up, but there's a best time to do it. And this chart that you see isn't necessarily the best time. So let me explain to you when the best time is to make this type of trade. The best time is to make this type of trade when the stock is selling off. So I'm just going to rewind in time. In early August, late July, this company had earnings. And we watch it very carefully. And the earnings, you can see at the very right edge of that chart, the stock got hammered. For one reason or another, the earnings didn't meet expectations, but we still really like the stock. And so when everybody else hates it and it's selling off, that's when I sell puts. That's when I come in. It's a contrarian day or days or week or whatever it may be, in that everybody's selling and I'm selling puts. Everyone's selling the stock and I'm selling puts, which is a bullish strategy. That's the best time to do it. And a couple examples, although they're not recommendations, they're past examples, right? When Disney recently came out with earnings and ESPN's struggling, and no one likes the stock, and it's sold off to under $100. Well, okay, we still like Disney, and this is not a recommendation, it's an example. If you still like Disney, you can say, well, I'm comfortable owning it at 95. And you can get a pretty nice income opportunity when everybody else hates it. Another example, American Express, when they lost the Costco cards, right? When Costco said, no thanks, and American Express said, no thanks, and they split. Well, everybody hated American Express when that happened, and the stock sold off. Well, if you truly understand the company, could be a good opportunity. Apple. 6 months ago, everyone was writing off Apple. It's done. It's finished. The iPhone's dead. Too many, market share shrinking, all sorts of stuff like that. And everybody started to hate on Apple. Okay, great. Everybody's selling it. I understand the company. I sell puts. That's a great time to do it. The other time is when what we call the VIX, it's the volatility index. I'm not going to go deep into this. It's for those of you that know it, it's contrarian to the market, meaning when the market is up, the VIX is down. When the market is down, the VIX is up. And when the VIX, with the volatility index, spikes, you see 3 examples. When it hit above 15 over the last year, that's when that keys me in and say, okay, great, I've got opportunities all over the place to sell some puts or some put spreads. Because the VIX and the market generally don't stay the VIX high and the market low very quickly. It usually bounces back pretty nicely in a bullish market. So that's the other opportunity to do it and to when to trade it. And I think those are very important, and that's why it's not, you just don't open your computer and sell puts every day. You got to wait. You got to wait. And here's something I really love regarding waiting and being patient, and that is a quote by one of our favorite investors is Warren Buffett. And he says this: what's nice about investing is you don't have to swing at pitches. You can wait for the pitch you want, meaning you can't strike out. You can take as many pitches as you want. You can wait for your perfect pitch to hit. There's no ball strikes. Wait for your pitch to hit. And this is, he continues, the problem when you're a money manager is that your fans keep yelling, "Swing, you bum." And this is so true. And I bring this up not as a negative, but to help you understand that this year I've hardly done any options. I've had clients ask me, "Why haven't you done more options?" Well, because the pitch isn't there. And this is also psychological. And what I've seen with most people that prevents them from being successful trading options is they have an expectation going in. They have a return target. They have an income target that they have to hit. And in order to hit that, you have to take the swings. That's the mentality, and it's so psychological, and that's the biggest barrier to people making money on their own trading these strategies, is they think they have to swing. Well, no, you don't. Warren Buffett says you don't. You ignore the fans, although you serve the fans and help the fans understand what you're doing and why you're doing it. But you wait for the pitch to swing. And the impact on the portfolio over time can be pretty darn big. As you can see here, it's a difference of 1.2 million over 20 years. So that's selling puts. That's a basic income strategy. That's what we wanted to discuss today. The role of options, the impact that it can have on your portfolio, when to trade and when not to trade. Think contrarian. When everybody's thinking one way, try to think the other. And then one strategy for your consideration, which was selling puts. Now, in the future, what we're going to do is in October, we'll talk about protection and hedging. And so look for further communication on that. That's going to be an eye-opening webcast for a lot of people. Protection and hedging. And then November, we'll talk about speculation, largely our bear market game plan in speculation. And then in December, we'll have a webcast on value investing with Brian Hunsaker, and he'll talk about that. So if you have any questions, my friends, understand this. We really love managing our clients' money and working with them to accomplish their goals. We love it. I love what I do every day. Love it. Relax. We can take it from here. If you want any more information on our firm, on how we do things, or if you have any questions, or if you're a client and you're saying, "Hey, I want more options in my portfolio," or I want to address options, feel free to reach out to me as well, brett@igga.com. You can also visit our website, www.igga.com. Thanks for listening. Talk to you later.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.